The mortgage process can be a complicated one, especially for those who haven't gone through it. And it doesn't help that there's so many misconceptions about the mortgage process in Canada, confusing Canadians. So in this video, I'm going to be busting some of the biggest mortgage myths that Canadians are confused by. Before we get in this video, I ask if you can like, subscribe, and share this video with a family or a friend because it'll help my channel grow and it'll reach more Canadians who are also looking to learn about the mortgage and real estate industry. So like I said in the intro, in this video, I'm going to be going over some of the biggest mortgage myths that are confusing Canadians. Starting off with myth number 1, which is pre-qualification and pre-approval are the same thing. This is just not correct, and it's really important to know the difference. With a pre-approval, a mortgage application is actually taken. Your debts are put up against your income and your credit score is taken into account to give you an idea of what you can afford. With a pre-approval, an application is actually going to be submitted to a lender, and once that pre-approval gets accepted, you'll be able to hold in a rate for up to 120 days. Now, a pre-qualification, on the other hand, that's equivalent to going on a mortgage affordability calculator online and typing in your income and debts, and it kind of shoots out a number. Now, using a pre-qualification tool is good to kind of get an understanding of where you're at, but it's not the most accurate number, and it has no worth to a lender. So if you're serious about purchasing a home, a pre-approval is the route you're going to want to take. Now, mortgage myth number 2 is that a pre-approval means you're going to be fully approved come time. Pre-approvals are great to understand what you can afford and to get that 120-day rate hold, but it doesn't guarantee you'll be fully approved once your deal goes live. The pre-approval process is missing one of the most important factors in the approval process, and that's the property itself. See, when you're getting a pre-approval, only the applicant's details are added into the mortgage application because there is no property. Now, once you get an accepted offer on a home, that pre-approval now turns into a live deal in order to get you fully approved on this home. And now the property details on your accepted offer are going to be incorporated into your application. That's why lenders will do an appraisal to get an understanding if they actually want to lend on the property or not. So a lender could pre-approve you and then you go put an offer on a home and get it accepted. But if the lender doesn't like that home for whatever reason, maybe they don't think it's in the best condition and they're not willing to lend their money on their home, they're not going to give you financing. Now, the third mortgage myth I'm going to be talking about is you can't get a mortgage after a consumer proposal or bankruptcy. Yes, it will make it more challenging to get a mortgage and work with lenders if you've had a past bankruptcy or a consumer proposal, but there are alternative routes that you can take. Lenders on the B side are willing to provide you with financing shortly after you've been discharged from your bankruptcy, and B lenders also give you the option to pay out your consumer proposal with the equity in your home. This will allow you to start the path to rebuilding your credit again, and then once you've repaired your credit, hopefully we can move you over to the A side. And then the final mortgage myth, and by far this is the biggest mortgage myth that Canadians are confused by, is that only first-time homebuyers are allowed to put 5% down on a property. The down payment rules for an owner-occupied home in Ontario are 5% on the first $500,000, 10% on the remaining amount, and then anything over $1 million requires a 20% down payment. Your first-time homebuyer status doesn't change the down payment you're required to put down. Now, if you're purchasing a home as, let's say, a rental instead of owner-occupied, these rules would change. On a rental property, minimum down payment is 20%, but for owner-occupied homes, the rules are pretty consistent. So here's a quick example on what your down payment will look like on, let's say, a $400,000 home. Doesn't matter if you're a first-time homebuyer or not, 5% would be required on that since the purchase price is under $500,000, meaning your minimum down payment would be $20,000. Now, let's say you bought a home for $750,000. Well, you're going to put 5% down on the first $500,000, equaling $25,000, and then on the remaining $250,000 to make up that full $750,000 purchase price, you're required to put 10% down. So that's another $25,000, equaling $50,000 minimum down payment on a $750,000 home. Hopefully this video helped clear the air on some big mortgage myths that Canadians have. If it did, please like, subscribe, and share this video with a family or a friend who you would think would benefit from seeing this. And don't forget, I also have those 3 free mortgage guides. The first guide is a first-time homebuyer's guide. The second is a refinancing guide, and the third is you found your dream home. Now you need to get financing on that home. So those are in the description below. Go click on that link and you can download them for free. Finally, if you have any questions, please comment them below. I'll be sure to answer all your comments. And if you'd like to have a one-on-one call with me, I have also my calendar link. That's in the description below. So go click on that, fill out a time slot, and I'll be happy to answer any questions you have.